It's a chaotic world out there: wars, tariffs, and economic uncertainty. However, such a combination of factors also creates a very interesting opportunity. During every major crisis, most investors were losing money. However, there were always those who profited heavily on each crisis. Because all of those crises share a common thing. Today I want to show you our two-pillar method. And while seemingly simple two-conditions-based method, it's a highly advanced and proven method specifically chosen to uncover those stock market opportunities that essentially lead to thousands of % in returns. We're always interested in the top-performing stocks of the S&P 500 index. Just to look at the past 5 years, Tesla is up 382%, Palantir 1,392%, and Nvidia 1,453%. However, to uncover such growths, it is essential to look for the two conditions that must be aligned. The first pillar that essentially guides us is the volatility VIX index of the S&P 500. Just to quickly explain to you, the goal for any investor should be avoiding high volatility, because when the market is volatile, prices move up and down more sharply. That means even a small drop can hit the stop loss you placed, closing your trade too early. If the volatility is low, we're much less prone to hitting stop loss on our trades. This is the VIX index over the past 20 years. We can clearly see, in comparison with the S&P 500, the negative correlation between VIX and S&P 500. Look at 2008 Great Financial Crisis, then the 2020 COVID crisis. And right now, the 2025 in February, given the tariffs. So as you see, only 2 other points in history reached this level of volatility. Historically, a VX under 20 signals relative calm, while anything over 30 suggests real concern. Scores above 40 are rare. They've only occurred on 51 trading days since 2010, mostly clustered in extreme events like the 2008 financial crisis. However, as you see in history, the volatility then calms down quickly. And right now, it's safe to assume volatility will stay low. Wait? Really? Even when US just entered war with Iran? Yes, history shows wars do not affect volatility that much. The war between Russia and Ukraine, too, did not cause growth of volatility that much. See? So even the current war is raging, we at Gleneus are assuming it will not stay like that for long. And the second pillar of our strategy is this: the risk-taking behavior of investors. We can expect the stock market to perform really well if investors are pushing plenty of money into the stock market. If they don't, or are not planning to, we can't expect S&P 500 to grow that much. That, along with the volatility, makes the two-pillar strategy. So how do we measure that investors are behaving risky? There is a variety of indicators that can be used to measure this. But what we generally like to stick with at Gleneus is the comparison of 20-day returns difference between stocks and treasury bonds. This indicator essentially shows you a snapshot of investor sentiment, whether they're favoring riskier assets like stocks or retreating to the safety of bonds. When stocks outperform bonds over a 20-day period, it's telling us that investors are willing to take on more risk. They're chasing growth, they're confident. But when bonds outperform stocks, that flips. Investors are moving into safe havens, meaning fear is rising. This difference acts like a pressure gauge for the market's mood. Now, if we look at the current safe haven demand chart, stocks are still slightly outperforming bonds, so there's still some risk appetite in the market. But that sharp drop from recent highs, that's a clear sign investors were pulling back, getting more cautious. As mentioned earlier, wars typically don't have a significant impact on stock market behavior. Therefore, we believe there will be increased demand for equities and reduced demand for safe haven assets. At Gleneus, we expect the curve to trend upward. To make this all clear, the two-pillar method we use at Gleneus is built on 2 key factors. First, we look at the VIX index, which tells us how nervous the market is. Second, we track whether investors are putting money into stocks or bonds. That tells us if they're actively pumping up money into the risky stock market, so we can see superior returns of US stocks. Right now, that setup looks solid. Volatility is low and investors are showing interest in risk again. The conditions are in place. But let's not forget one important risk. If the trend changes, if the S&P 500 starts falling, one of the first places we look is oil. With the US now involved in the Israel-Iran conflict, oil prices could jump fast. And that shift matters, not just for consumers, but for companies too. Rising oil means rising costs, and that puts pressure across the board. An increase in oil prices could be brutal. This is the oil price in context of past 2 months. The oil price depends on several factors, however. One of the most brutal impacts could be from war like this. Israel-Iran war could set oil markets in fire. Goldman Sachs sees $10 to $20 per barrel spike. According to Goldman Sachs, Brent crude oil could rise from around $70 to $90 per barrel if tensions in the Middle East escalate further. For consumers, that means higher prices at the pump. But the bigger issue is what it does to the broader economy. Oil isn't just fuel. It's a core input in transportation, manufacturing, and logistics. When oil gets expensive, production costs spike across industries. Combine that with already weak consumer purchasing power, and you have the conditions for a slowdown and, or worse, a financial contraction. If you like this video, don't forget to like, comment, or subscribe. Thank you.